It is my pleasure and great privilege to chair the first plenary of ASI 2015. And what we'd like to do in this very first plenary is to, I guess, do a stop take and consider the nature of Australia, the nature of our past returns, the nature of our investment attributes here, globally, to talk about the investment environment and to talk about the key issues that we as an industry see from an investment perspective given the current situation. Now, we have a polling question, so I hope that most of you are much better at downloading apps than I am and will be able to vote. So could we please have those polling questions up? Yes, we do. So I'd ask you if you would mind just voting on the question up there. What is the biggest investment-related challenge facing your fund today? So we've got a number of different options. And look, we do hope to use your responses as a guide, frankly, to our discussion this morning. So the idea of this session is, after I've finished rabbiting on and sat down, each of the three speakers will get up and speak briefly from their very, very different perspectives. Christian, Jay and Michael. And we've deliberately tried to find three different individuals with three different areas of expertise and different perspectives as well on the issue we want to talk about today. So once they've finished speaking, we'll then open to Q&A. We will have ourselves some questions that we've thought of, but we'd very much welcome your questions as well from the floor. I mean, we can't talk about how likely it is that Richmond will make the grand final for the rest of the session, much as some of you might like to. So I do ask you to send through questions during the session. So we have the feedback, meeting our product return expectations. Yes, an unsurprising response, frankly, given what is occurring in terms of expected returns across asset classes. And that'll certainly be something that we focus on today. The lucky country, where are we now? We're known as the lucky country. As we know, Australia has enjoyed an unprecedented period of around 25 years of growth without a recession. We are, however, for better and for worse, a key beneficiary of what happens in China. And it is, I guess, interesting for all the wrong reasons that the issue of China has now taken on such incredible significance in global financial markets. Starting around a month or so ago with changes in their currency exchange rate mechanism, we've seen ongoing declines in their equity markets, and we've seen a huge impact from these particular moves within China across global markets. So this morning, for example, the Australian dollar is barely above 70, indeed it may well be under as we speak, and we know that markets in the US closed down around 3%. So as a key beneficiary of China, I guess today is a great time to ask, is our luck running out? What are the key challenges that we face? What does the current environment mean for investment objectives, for strategic asset allocation and other investment-related issues? What could be the impact of rising rates? We should be so lucky. And what about diversification? So these are some of the issues that the speakers will be talking about. So Christian, as I said, will be first. He'll be speaking about the key challenges that he sees as Executive Manager for Investment Strategy at CBUS. And we've stuck very, very closely to ASI's guidelines for no charts, no tables. Christian has resorted to tearing bits out of the newspaper for some of his slides. Jay, not to be outdone in his presentation, has hopped into his child's box of building blocks, and he has a number of different shapes. So he will talk about the shape of risks that he sees. So he joins us from New York, where he works with Lazard. He's an MD and portfolio manager leading Lazard's multi-asset investment team. And then we have Michael Schneider as our third speaker. He's the CIO at Brookline Partners in Melbourne. He'll be talking about where are we now, what are the implications given where we are, and what do we need to prepare for. So the aim of the session altogether is to discuss the challenges we face and, frankly, to challenge the way we think about these challenges as well. So just before I ask Christian to come up, can I just remind you, please do use the AXA Investment Management Q&A, which is now open to receive your questions, because we very much look forward to being able to speak to those as they come up. So if I could now ask Christian to hop up to the lectern, please.
Thank you. I'm going to take a perspective which is not really going to focus too much on specific investment ideas and so forth. I think our other panellists are going to put that on the table, but I do want to sort of, I looked at the theme, and the theme was, you know, lucky country, where to from here? And I sat back and absorbed, you know, the industry funds as a microcosm, and I think we operate within a lucky country, but yet we're actually in a very lucky industry within that lucky country. And one of the, I think the challenges that you face when you have such a tailwind for so long is that what you end up with ends up being much bigger than actually your internal capacity should be. And so when you've had a lot of tailwinds, you can sort of get away with doing things in a particular way and still get very good returns. But when things change and challenges change, that's really where the test is. So I'm going to talk about that and some perspectives that we have, and hopefully that'll provide some interesting things to think about. So I think it's acknowledged that the investment environment has become more challenging, but I think we do need to remember that the rest of the world, for quite some period of time post-GFC, have actually had to face a challenge that we are only slowly beginning to face now. So we have to, when we are investing, really think about not just ourselves as you know, investors from here looking out, with the luxury of having had cash rates that were still lower than previously, but still were compensating for inflation, to being really faced to be in a position to invest where it's highly likely that we are, you know, and we're seeing this, we are not insulated indefinitely from the effects of what's going on. So we need to start to prepare ourselves better. And we're seeing this. I mean, we're seeing this with our cash rates at historical lows and the potential for that to continue to go down. There was a substantial period of time where the long end of our yield curve seemed to be materially higher, very attractive for other investors, but you know, the weight of money is now even impacting on that. So we are completely connected to the world, but we're seeing the impacts of what's going on a little slower than others, and we should be, I'm not sure whether we're quite as prepared for that as we should be. Sorry, I've been told to press it slowly. Technical problems. There we go. Okay. I think the way that we've sort of looked at challenges, and I sort of want to break it down in terms of forward-looking returns, I think there are long-term challenges and headwinds, and then there's shorter-term challenges. And the way that we've sort of reviewed things is that we believe that there are factors like the ageing population, big headwinds as the long-term super cycle around debt starts to unwind. Other challenges like adjusting for a lower carbon world, or if we don't adjust, having to deal with the impacts of climate change. Those things have been assessed, and I think we, like other funds, have concluded that our view and lens about what's reasonable in terms of returns from the past needs to change, and so we have been lowering the returns that we're expecting to deliver. On top of that, we've also got an environment where some short-term things are potentially challenging. And if you think about what we're trying to do, we're trying to provide retirement outcomes for members. We have quite a significant challenge in the sense that we've got longer-term returns that are lower, but we've got an ageing population, but longevity and so forth. So it's like we're trying to chase an ever-moving target. We need to be able to structure resources internally to be able to adapt to those new challenges. There we go, I've got to lift my arm up. One observation I would like to make is that the perspectives of how we invest and what others invest are quite important, and it does make the challenge of understanding whether things are expensive or not a little more complicated. And I'll say that we have started from a position where we've been early adopters in things like infrastructure. We've actually been able to take the sort of the benefits of sort of de-risking of the views of that asset class. We start off with higher allocations, yet what is happening, and this is a natural impact of having very low cash rates for an extended period of time, is that there are large and quite significant investors that are making what are relatively small shifts away from quite predominantly bond portfolios into these assets, and the quite rational decisions that they're making are significantly changing the dynamic in terms of the competition for the assets that we traditionally think about. What it poses as a challenge is A, being able to access it, B, I think a different lens on what is expensive or not. And so this is something that we need to think very carefully about how we respond. To give an example, the Japanese government pension investment fund is $1.5 trillion. It has the option to move up to 10% of its assets into real asset type strategies. Even if it took a toe in the water approach and say move 2%, that's equivalent of a CBUS fund, $30 billion. So we're talking about, this is one example, and there are many examples like that. We're seeing state-owned enterprises coming and talking to us for the same reason. So this is actually a big new wave that we need to consider and work around. Fees. I know there's a lot of sessions. There'll be a bit of debate about this going forward in other sessions, but I'm going to put a couple of things on the table. From my perspective, I think that the current model, the way that we invest, which is traditionally to take money from members' accounts and allocate, does not scale. It will not provide the benefits that are needed. We think it's not just a question of trading alpha and return. The fact is that we have strategies that are now capacity constrained, businesses that are aligned to be not overly reliant on one client, and so we're faced with a situation where we are forced to forever add managers and continually replicate fee scales, and we actually lose that benefit. So our perspective is that we're going to have to fundamentally change the way that we do investing and that we work. We have committed to reducing fees. I'll talk very quickly about the sort of things that we are considering. Consolidating mandates, where there is unnecessary duplication, we need to actually think about how we take proper advantage of scale. It's just like when you go around and you think about how you procure things, you just have to be more intelligent about that. I think, and this is you can interpret this how you like, but we do need to break the nexus between the manager being the sole source of ideas to us actually being the contributor of ideas. Now, how those ideas get into the portfolio is up to discussion, whether that's through an internalisation or whether it's through a different arrangement with managers, but that is one response that we need to take to change the situation. And we will be working with different entities. I think we've been probably too constrained in just working with funds. There are plenty of entities out there that are looking for investment capital, banks, companies directly, other investment institutions globally and also domestically. And I think the other thing is that there's a real need to drive that fee culture within investment teams. I think it's been too easy for us to use the alpha argument And so there does need to be a cultural shift in the way that we think about things. Last slide, because I'm conscious I'm actually more over time than I promised, but we'll get there and hopefully we'll get some more time to extend based on questions. So what are we doing? We've actually gone through quite a process about actually really changing the way that we think. And it's reflective of the fact that we've probably grown faster than actually internally we have adapted. So we started from the basics 2.5 years ago. We put in place much clearer priorities around what we are trying to achieve. So we have a lower focus on what others are doing or what other returns, competitive pressures, and we're actually putting in a focus where we are willing to be different if the activities that we are doing are going to add value and also add to the risk-return sort of benefit for members. There's been a massive change in the way that decisions are made within the fund, much clearer structure around who makes what decisions. So, and believe me, this is a process that actually does require a lot of time to iterate and get right. But we've gotten to the stage now where investment committees are actually thinking and talking about things that really matter for the portfolio, bigger exposures. They are not having beauty parades with fund managers. We've got an internal investment committee that does that now. But even the internal investment committee doesn't see the fund managers, it just reviews the recommendations. We've got individuals that are more accountable for the strategies that they put in place. We've had to really beef up the information systems that we have in place. So we've got now actual access to the security information in our portfolio. We can see what's going on. We can differentiate between how our portfolio is behaving when something happens in China versus the broader Chinese market, so we can actually really go to a different level of understanding. We're trying to put in a framework where we take advantage of the fact that we think about the portfolio as a whole. I think there's some real advantages in having specialisation, but I think there's some even greater advantages in terms of being flexible about how you put forward capital and invest capital outside and around perhaps the way that people conventionally think about things. So for instance, there's probably no point in competing against banks, but banks have a particular capital requirement and process. That leaves a gap in terms of funding and requirements that we can probably fill as a different type of investor. We've changed the custodian relationship to give us far more flexibility to actually address things such as product solutions, but also to introduce a different range of, I suppose, sophistication in the way that we can actually manage the portfolio. Going forward, I'll keep this very quick. I think we've had a subsequent review, and what we really want to do is to change our investment mentality from being an allocator of capital to being a true investor. So you will see us going out and talking to very different entities before we have a company visitation program. We will be talking to banks, not just in the concept of us allocating cash, but also in terms of what relationships they can perhaps bring to the table and where they sort of see opportunities where they're constrained and another type of investor would be suitable. We have a strong reputation in terms of investing in the real economy through CBUS property. We think that is something that we need to leverage, and we need to have the capacity to work further with. And finally, also a greater capacity to innovate and to test new ideas. So, better back office support, quantitative tools and a quantitative team and so forth. I've talked enough, so I'm going to stop here and let others come on. Thanks.
Thank you, Christian.
Well, thanks to everybody for asking me to talk briefly. I think as members of the first plenary, we're given the luxury of just asking questions without the need to actually answer them. So I thought, for a few minutes here, I will try to talk about the most dangerous shapes in finance. I've tried to obey the rule of no chart, so I've had to, as Robert mentioned, use kind of more shape-based. So I think the first most dangerous shape is the bucket. The second most dangerous shape, which is related to it, is the pyramid. And finally, the very ominous bell curve, or the normal distribution. So let me start with the bucket. How many of you, maybe a quick show of hands, know what the Dewey Decimal System is? Right? So most of you. This is the system, for those of you who didn't raise your hand, that libraries, about 85% of the world's libraries, use to actually classify books. It is something that was invented by this man, Melville Dewey, in 1876. And he decided that he was going to take on the very serious task of classifying all human thought into 10 categories, because that's the number of categories he felt was nice and neat and appropriate. And I think it's interesting. There's a book by a man called David Weinberger called Everything is Miscellaneous, and he gets into this in some detail. Human beings are very good at classifying things that belong in the physical world, right? The reason for a library system that classifies books is because the books have to physically reside somewhere in the library. The problem became apparent. I mean, when you look through the classification system itself, the original one that he put forward in 1876, you'll find there are about 65 subcategories dealing with different elements of Christianity. All other religions were classified under occult practices. Right? I mean, something that, in the end, was a decision that this man made himself, right? Because he was in charge of classifying all thought. And those categories that may have been appropriate at that time are very hard to change. You'd need all of the librarians to get out razor blades and scrape off the numbers that they've put with liquid paper on the back of all of their books. It's a little bit too daunting, right? Because in the physical world, we have to place objects in physical space. But in the theoretical world, in the digital world, and certainly in finance, we don't have to adhere to that constraint. We don't have to listen to the who and the what. We can classify things in totally different ways. And I think that we have, I mean, as an asset allocator, my job is to create solutions for clients, customized solutions. And the first step that I think is often overlooked is, what are the levers that you're creating in order to pull? What are the asset categories? And why do we obey the traditional ones that Markowitz proposed many decades ago? It's not necessary. We should really be making up our own buckets. Now, the second most dangerous shape, the pyramid. Now, the pyramid, you're thinking, well, this is about the Ponzi scheme, because of course you've got Bernie Madoff and others who have used the pyramid to their advantage. But what I want to talk about more than the Ponzi scheme, which I think has been well articulated as a danger in finance, is what all of these categories end up leading us towards. They lead us towards hierarchical systems, where something is at the top and all of the things start to inherit from their parent category. I think that if you consider GICs, for example, they are the Melville Dewey of our time, right? They have decided that they will classify all stocks into 10 sectors and industry groups, etc. One of the things, and this actual slide is from their website, one of the things that's very funny about this, when it struck me, is that the thing at the top of this pyramid should say stocks or the market. Instead, they've decided to put themselves at the top, that GICs is actually at the top of the universe, and then they subdivide GICs into 10 sectors. It's quite dangerous, because I think, of course, when we're thinking about allocating assets, we should really be considering what is at the bottom of the pyramid and how should we group those items together so that they actually have something in common with each other. One of my favorite examples of how this is changing in our society, and I'm sorry, I know that this probably violates the squinting rule, but you're not actually expected to read everything on that slide. You have got a screenshot of the Yahoo homepage from 1994, which was the most visited website then. And what Yahoo tried to do is actually just classify the internet into these directory structures, right? Business, sports, I mean, basically following a newspaper layout. And at the bottom, which you can't read, it says, this contains all 28,000 web pages that exist, a number which is totally ridiculous. Eventually what happened is this process of trying to categorize web pages was recognized as being ridiculous because there are too many possible categories and people will disagree about what falls under what. And furthermore, these aren't physical objects. They can actually exist in multiple categories. And I think we take it for granted now, but Google actually provides a much simpler way of finding what you're looking for, because it goes right to the bottom of it and it pulls it out for you. And in a way, you're creating a category every time you do a Google search. And I feel that in finance, what we have to start moving towards is a system that's more like that, where actually we listen to what a client or a customer or a consumer of our products actually wants, and then subdividing, based on that end objective, what the categories ought to be. And then finally, I think the bell curve. And this comes back to this idea of inheriting from the parent. I mean, the classic example of this is how our industry is actually broken up. I mean, most of our clients, most of our firms are separated first along the lines of maybe equity and fixed income, for example, right? And then the fixed income guy says, okay, well, yields are too low, so I need to actually find something with a higher yield. But I still need to be safe, so I'll get a government bond. But I need a higher yield, so maybe I'll get a Venezuelan bond, right? And now all of a sudden in your safe category, you've got a Venezuelan government bond, right? What he couldn't do is just buy a stock, right? Because that's in another department. That's another guy's job. He doesn't deal with stocks. He deals with bonds. And I think that the distribution that you see here, as on the left, is very dangerous, because this is really how our industry still insists on classifying risk, with volatility, right? The normal distribution is quite dangerous even with stocks. It's even worse with bonds. With stocks, just to give you a sense of this, if you think about 5 standard deviation moves, in the S&P 500, if you assume that volatility is a good measure of risk, those moves should happen once every 14,000 years, give or take about 50 years, right? They've happened 7 times in the last 5 years. So either we're extremely unlucky in this particular period, or the actual measure of risk is completely wrong. With bonds, the outcome of returns actually looks like the other chart a lot more than it does the bell-shaped curve. It doesn't even have a bell-shaped curve. The vast majority of the outcomes are positive. You get your money back at the end of it with a coupon. But when you do not get that outcome, the result is actually much, much worse, because you have nothing. You've lost the principal of your investment. And the idea of categorizing bonds in a way that we use to categorize stocks, to me, is quite dangerous. Because if you think about it, most practitioners, they use historical data to calibrate all of their asset allocation choices. You know, the trailing 5 years, or maybe if you're lucky, the trailing 10 years. But if you look at a graph of what global bond yields have looked like since World War II, it actually comes back to that pyramid shape, right? I mean, they went up and then they went down. And I think now we're on the cusp of this change where it's very hard to say that the next 40 years will look like the last 40 years in bond yields. And I think we all recognize this, but then when we go back to our desks, we're still using the measures of historical risk and return that have been used in the past. So anyway, hopefully that has answered nothing but asked something, and I'll hand it off.
I'd actually like to take 1 point each from Christian and Jai and take them in different directions, and I'll hopefully explain why that is in a minute. The first point that Christian made was around the idea of going from a tailwind scenario to a headwind scenario. And whilst there are plenty of forecasters out there, there are also, I suppose, not enough consideration given by many people to the vulnerability of risk. So it's not a matter of, in my view, I should say, to predicting events. It's about predicting the vulnerability to certain events. And in terms of Jay's points, I think the other point is about how we measure risk. And so I wanted to kind of take that in a slightly different direction too. So Rob's given me a fairly good introduction, so I don't need to go over this too much. But where I think we are now is that risk measurement is not really fully revealing of the magnitude and quantum of risk in markets, particularly in a recognising non-linear nature. The other point I'd make is that risk or valuation tools don't really work as effectively when the risk-free rate is effectively zero or close enough to it. So what that implicitly means to us, and using the comments made by Jay, is that many valuation tools fail to recognise adequately the dynamic relationship between debt and equity, and I'll explore that in the next couple of minutes or so. The other implicit point I think that Christian made, which I think is very important, is how good are the markets at the moment as a signalling mechanism. I would argue that capital flows are far more important than the markets as a signalling mechanism, and that's a key distinction I think that bears watching in the next few weeks particularly. So what does that mean? We've got a vastly different resource allocation that's taken place in the last 7 years. It's showing up in productivity numbers. It'll show up in an asymmetric way in our view. And getting back to the concept of risk measurement, which I touch on down the bottom there, that a 10-year bond at 2% is 40% more volatile than the same bond at 5%. So to outperform a 10-year bond index using a 10-year bond portfolio by 1 basis point requires 40% more risk. So how risk is measured is going to be very important as to how attainable tail risk protection is. And so where I think if you don't diagnose the risks adequately, then you won't get the outcomes that you're seeking with all the best intentions. What do we need to prepare for? I think it sounds like the late news, I guess, today, but we need to prepare for disorderly markets for 2 reasons. One is if we believe that markets as a signalling mechanism are not as efficient as they have been perhaps in the last 10, 15 years. We also need to recognise that you can outperform an equity index and a bond index, and given that share buybacks and debt-funded dividend payments are quite topical, particularly in the US, you need to understand, I think, that you can outperform a bond index and you can outperform an equity index, and you can still lose value from slippage between debt and equity holders. And we all know what happens when the rubber band snaps back, that equity holders have been the main beneficiaries of debt-funded buybacks when the trend in bond yields goes the other way. And we think the trend in bond yields has been the most important thing in the last 7 years, not the level of bond yields, but the trend in bond yields. And so then you can start boring down, I think, into how economic potential is being overestimated. I touched on productivity, also how sustainable price earnings expansions are when profit to GDP, for example, in the US is now declining, I think, for its 2nd year in a row. The justification for a lot of asset expansions, sans the Fed, are not there. So what are the solutions? And this is more a topical, I guess a topical viewpoint from myself, but to sort of start a discussion going with my colleagues and the whole room for that matter. How you define risk when you've got a bond yield that is far more volatile than what it was 7 years ago or 8 years ago, how you measure that risk in a dynamic and non-linear way will determine your capacity to attain tail risk protection. I also believe that you cannot look today at the claims on a business in isolation from the point of view of an equity holder and the point of view of a debt holder, and I think Jay touched on that before as well, which I think is a really, really important point. Otherwise, the vulnerability for value slippage in such a low return world is quite acute, and it's a subplot underneath all asset markets in the world, in my view, at the moment. So when you can separate how you measure risk in recognising that it's a dynamic and non-linear relationship, when you can look at the claims on assets at the asset level rather than at the debt or equity level, if you can combine those 2 things, I think you're well on a way to a pathway of uncorrelated returns in a very, very interconnected and a very, very correlated world. So, and in that sense, I think it's inarguable that the world has never been this interconnected and it's never been this correlated. We're seeing that in capital flows in China, emerging markets. $1 trillion has left emerging markets in the last 12 months. So I guess a great discussion point is, where do you hide? How do you quarantine risk? And I think it's actually how you redefine risk is how you quarantine it and how you decouple investment strategies from very, very interconnected and correlated asset markets. So I just wanted to kind of throw that up for discussion for everybody, and welcome any questions.
Thank you, Michael. All right, so once again, we welcome your questions via the app or alternatively from the floor. But just before we get going, is it possible to have the results of the survey back up on the screen, please. Because I wanted to go back really to what that survey revealed about by far the most significant investment-related issue, meeting our product return expectations. Gentlemen, challenges, how could one approach that issue today best?
There's
ideas?
two key words in the question. The first one is meeting, and the second one is expectations. I think that we're in an environment where a lot of the expectations are still anchored to points in time and measurements from maybe 10 years ago. So I think that there is the question that I think you actually highlighted it quite well, redefining the risk and reward dynamic of today's world. But there is, I think, also, I mean, we see a lot of our clients around the world, they have, I think, expectations that need to be brought down a little bit. Particularly in parts of Asia, they're still under the view that CPI plus 8 is a reasonable target if you just have enough risk. It doesn't quite work that way.
It really comes back to, I think, to a unit of risk versus a unit of return, and it's how you define that unit of risk that the return flows afterwards.
Yeah, I think one of the traps we can fall into is trying to engineer outcomes in the future that try to match what we expected in the past. And so, for instance, on the risk perspective, if risk is actually generated by capital flows, which I suspect that the situation is likely to be going forward, then if you're trying to invest for members over a longer period of time, and you have reasonable information about what is a flow-related thing rather than a fundamental shift in value, then your better approach is to actually tolerate that risk and invest in that environment appropriately. Probably the most difficult way of trying to do things is to try and, whether it's through options or other things, bring that risk parameter down to what we're used to. And I think it's fair to say that, setting aside the global financial crisis period and little blips, the reality is that we've had an extended period of probably excessively low volatility for really the sort of investments that we have been investing in. And it could be that just because of information and the way that capital flows, we should be expecting and managing in a higher short-term volatility environment.
A great illustration of both your points, I can relate back to my father, and he was invested, he's retired now, he started planning for his retirement I think when he was 15, but he was invested in semi-government bonds, 5-year semi-government bonds on the other side, on this side of the GFC, so he had no basis risk going into the GFC, no market risk at all going into the GFC. He approached me about, I think it was about 2 years ago when his bonds were maturing, and this gets back to the categorisation point. I think this is such an incredibly important point. And I said to Dad, he said, what should I do now? And I said to Dad, you're going to think I'm completely crazy, but I think a Telstra equity at a grossed up yield of something, I think it was at the time around 8.5%, is far less risky than a government bond at 3.5%. And when you have the categorisations that Christian talked to and Joe did as well, the categorisation doesn't recognise, and that's one of the implicit points I was making before, that this, categorisation doesn't recognise value slippage between debt and equity holders.
We've got a great question. We've got a lot of great questions to come up, but one that just happens to be top of the list at the moment is a very real issue, and that is a question about how do we get retirees to basically change their expectations, given that they have expectations built on 20 or 30 years of historically strong returns. Do we have some views on that? How to change that orientation?
I think we can use technology a little bit in terms of trying to find a different way of educating people around the impacts of what short-term things might do, and then what that might mean in terms of much longer-term goals. simple things that we're doing is we're starting to do things around looking at adequacy and projecting, what a member's retirement balance is going to look like. I think we need to have a good conversation with managers about what are the levers that can be pulled around the retirement outcomes. So there's a contribution aspect, there's a risk return trade-off aspect, and then there's also just whether they may need to redefine their expectations about how they plan to cope with the retirement phase. So I think there's a lot of things that we can do, and in some sense, I was sort of alluding to this challenge when I was talking about the issues with providing the right adequacy with retirement. I think the other thing that we can do is, and I think we're starting to see this as well, is talk about retirement not in isolated things, but actually talk about it in a much more holistic policy sense.
I think there's two really important issues with that question. The first one is that, by implication, if that's the scenario that we're looking forward to, then investment playbooks have to change. And that's what everybody here has talked to in different ways and taken in different directions in a short time this morning. The second point I'd make about that, and I think this is a key point, at least all the great investors that I really look up to, and there are a lot of them, are far more defined by what they avoid over their investment lifetimes than what they embrace. And it's just simple, it's just the magic of compound interest. Don't interrupt the magic of compound interest.
Now, can I just remind you, as we're just hopping through this session and clearly very near it, just to use the app, please, to submit your feedback on the session, feedback and comments. Now, can I ask, are there any questions from the floor at all, please? If not, we've got another great question here about the current debate about the categorisation of growth and defensive assets and whether or not that's a completely futile way to think about the classification of assets. I think some of the discussions we've had this morning would suggest that the categorisation can be quite a significant misnomer. So thoughts, please, on the categorisation of growth and defensive assets, how sensible it is, how useful it is?
Could I just take a quick shot at that as well? I think the best illustration I can think of in answer to that question, and this gets back to the idea of what does a different investment playbook look like. The best example I can think of in the last 10 years or so was when Berkshire Hathaway bought BNSF, which was the second largest rail network in America, and I think still is. And what struck me with that was that we've got this return on equity culture, where and it's sort of gathering momentum at the moment, which suggests we're getting near the end of this phase, and the mathematics say that it will end. I think the different playbook that Berkshire applied when they bought that, and I was at Omaha, I think it was the year before last, when Charlie Munger talked about it. He said it took us 10 years to recognise how valuable BNSF is. And so they were shown that deal 10 years before they bought it. What I think got them there in the end was that they decided that what their investment playbook needed now was capital intensity. So capital intensity is the new playbook that Berkshire used in terms of recognising the value of that asset. I think that's incredibly insightful change in tactics, where Berkshire, they have the same investment value system they've always had in 50 years. But how they express that investment value system, is vastly different. And I thought that was an incredible insight to me, at least.
I think on the issue of regulatory categorisation and so forth, and then how you invest, I think it is possible to separate the two. I think that the trap is if you actually allow the way that people require you to categorise the way you invest to actually drive how you make decisions. The reality is that everyone's going to try and simplify very complex concepts into either one number, two numbers, or what have you. And I think it's part of our responsibility to be very clear about what we're doing and articulate the rationale in our own terms?
No, I think the over segmentation is a problem as well. I think having a much broader category and letting other specialists decide how to break those categories up is a much better way of diversifying. So if you have two different managers and one of them sees a world in structure A and the other in structure B, I think you've got a reasonably good diversification of approach, as opposed to if you decide from the outset how everyone ought to subdivide their assets and then find specialists that might compete in each one. I think there, the risk is on whoever is creating the categories. And so really from the end client's perspective, they should come in with an objective about a risk, and it can be quantified in a number of ways, and we can talk further about that. But risk and reward are really the end objective of the investment. And the more that you subdivide the categories and try to insist on specialization, I think you actually constrain investors quite a bit more than either you or they might really be aware of.
I swapped an email with Jai a couple of weeks ago, and I think what sums up his views perfectly in my mind is a quote by John Lennon that said, what most other people see as surreal, I see as real. And the best example I can think of with that is that in a typically vibrant, developed world capitalist system, banking and finance should be the oil that moves capital around the economic machine. And when you start seeing a banking and finance sector that's in the order of 40% of stock market capitalisation, something like 60% of debt market issuance, banking and finance became the machine. And we're seeing very early signs now with the regulatory environment, with the equity issuance in the Australian banks. We're seeing the sign now that banking and finance is reverting back to being the oil rather than the machine. So you need to be a fairly adaptive thinker to prepare for a scenario like that, I think.
I actually think the way that people categorise things, if you are willing to be different, is actually an opportunity. Because if you're able to find where there are gaps and actually construct a solution, and to be honest, if you think about us as investors, and you can argue all you like as to whether we could do everything well. I don't think you can. But the one thing that we have to do well is we have to know our portfolio, and we have to decide how we can allocate capital in the best way. And I think if we think about our portfolio in a total sense and recognise actually that there are opportunities by being different to what people expect, then that's probably part of where the opportunity is that we can add value to our members in terms of returns.
Well, gentlemen, we'll need to wind up the plenary there. So can I say thank you to Christian, Jay and Michael on behalf of the delegates.